Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and I'm joined again today by Glenn Schultz, who is the head of our agency mortgage prepayment modeling and strategy for MUFG. Today is Thursday, July 14th, and Glenn, thanks for joining us again. Nice to have you back.
Hi, Helen. My pleasure. Thanks for having me on the show.
Sure. So listen, July remit data was released earlier on July 7th. Aggregate prepayment measured by Fannie 30-year declined about 5.5% on a month-over-month basis, down to kind of like 9.3 CPR. And to kind of recap the backdrop that we're working with here, the 30-year mortgage rate has come down modestly since June and is currently around 5.3%. Against the backdrop of a higher 30-year mortgage rate, the housing market appears to be cooling. And then we have the Fed, who has signaled that will continue to raise the short-term interest rate while MBS purchases are likely to end August, September timeframe. So with all that said, what are your thoughts with respect to this month's prepayment report, the state of the housing market, and your outlook for the mortgage basis here?
Sure. Well, with respect to this month's agency MBS remittance data, aggregate speeds, as you mentioned, as measured by Fannie Mae 30-year MBS, really presented a considerable dichotomy across the coupon stack. So, for example, we pointed out in this month's commentary that the turnover coupon based on the driving rate in our prepayment model is the 4.5 coupon of 2019. This cohort has a 524 gross WAC and a weighted average loan age of 38 months. So this is moderately seasoned. And for this cohort, June prepayment declined 18% on a month-over-month basis to 22 CPR. So that's down from 27 CPR in the previous month. And that's an indication to me that we're beginning to see an alleviation of the pressure on prepayments that are related to really what we've been witnessing as very high turnover rates. And we've discussed this at some length in previous podcasts, but there's some interesting points here. First, the turnover measure is at or very near the top of the coupon stack, not at the belly of the curve, which is somewhat unique to see turnover being measured that high up in the coupon stack. And then again, as I mentioned, the turnover rate remains very high by historical standards. So the high turnover increases, at least in my opinion, the forward carry at the top of the coupon stack. In particular, the moderately seasoned, so that's 30 to 60 WALA, 4.5 and 5 coupons for the following reasons. First, I think we'll see turnover rates begin to decline going into Q3 and Q4 2022. So this will increase the carry value of these cohorts. Secondly, employment in the mortgage lending industry will decline further. And as a result, cash out refinance activity will likely be weaker than many expect. And I should add that these moderately seasoned, so we'll say 2018 through 2020 cohorts of 4.5s and 5s, are really high FICO cohorts as well. And so that reduction in capacity will favor those cohorts. And then finally, the coupon stack has flattened in the last few weeks, making current valuations at the 4.5, 5 coupons relatively attractive versus the bottom of the stack, say, compared to a month ago.
So as you mentioned, cash out refinancing activity, the housing market does continue to show signs of slowing. What is your view with respect to the housing market as of today?
Right. Yeah, we are seeing signs of a slowdown in the housing market across several metrics. And, obviously it takes time for higher interest rates to work their way through the system. But what we have seen recently is the number of contracts canceled has increased in the past 3 months. So we're getting very close. We're not there, but very close to sort of peak cancellation rates that we had seen at the onset of the pandemic. And this is leading to increases in inventory and some price cuts, at least in some markets, right? The hotter markets in particular. Existing home sales, months on market, has increased somewhat to around 2.5 months. And that's reflecting the slowdown in housing and also leading to higher inventory levels. So that said, in the aggregate, the market or the housing market is still biased to a seller's market. Now, the National Association of Realtors Affordability Index is actually at 100. So that's very low. That's back to kind of pre-financial crisis indicators. And that means that really buyer with the median income can purchase the median price home. This isn't to say that we're going to have a housing crisis or anything like that, but affordability has dropped kind of considerably. And so I think you'll see a slowdown, obviously, in sales, and a number of potential buyers now are going to be taken out of the market. So as I said, a slowdown in the housing market does not mean a housing crash. I suspect the housing market will revert to the mean and normalize in terms of existing home sales, months on market, and inventory over the balance of the year. And this will alleviate the demand-driven home price appreciation. However, the question in my mind is the impact of inflation on home prices. So that's really to say that the fundamental driving home price appreciation may shift from housing demand-driven home price appreciation to that of commodity price-driven home price appreciation. Still, at the end of the day, housing fundamentals don't directly drive valuation in the agency MBS market. Rather, agency MBS valuation flows, at least partly, through the issuance channel, which reflects the supply and demand balance for agency MBS securities.
Thanks for that, Glenn. And I'm glad that you mentioned the agency mortgage issuance, as it leads directly into my next question. Has your outlook for net agency mortgage origination changed over the course of the past couple of months?
Yeah, overall, I still believe that we will reach the net issuance projections that we had made in December of last year. And so that number was between 600 and 800 billion. Now, as of June remittance, gross issuance was just over $1 trillion and pay downs were 544 billion. So net issuance at the 6-month point of this year stands about 480 billion. That's just 120 billion shy of the lower end of our forecasted range. So I do think that we will begin to see the impact of a higher mortgage rate on issuance going forward, with gross issuance declining in the second half of the year, as will pay downs. Netting out the two, I think the market will certainly hit the midpoint of our estimate of around 700 billion, with an outside chance to the high end of 800 billion. So it's not so much a question of whether or not issuance reaches our projection, but rather the path changes somewhat in terms of issuance and pay downs.
Understood. So how does this play into the mortgage basis and the old normal thesis client note we sent out in April? Has your view changed, and what is your outlook going forward?
Right, the mortgage basis. So since the April client note, the basis was following a technical setup, which we felt would provide credence to the old normal thesis. But at the end of June, the basis actually gapped wider. And I think in large part owing to the fact that the market accepted inflation as becoming somewhat embedded into the economy. Now, in our view, 140 basis points is the wide end of the old normal range. And from a technical perspective, we believe the old normal thesis was more or less proven by a somewhat narrower trading range, say between 100 and 120. So with the basis trading just north of 140 basis points, I feel like the old normal thesis has really been validated at these levels. Now the question is, where do we go from here? So to answer that, I think first, there's going to be a further widening of the basis to say a financial crisis is unlikely, right? Absent kind of a significant liquidity event. So we're not going to see these sort of extreme numbers, out approaching 200 basis points. So it seems to me at the current level, the basis represents a value entry point. Then the second is demand. So we project Fed purchases will likely end in August, September. However, at this point, investors have largely stepped away from the market for now, which creates this demand vacuum. And I think the key question is the degree to which banks re-engage with the agency MBS market. The extent to which loan demand does not materialize as forecasted by the banks will likely resume agency MBS purchases. So I think there's a lot of cash on sidelines in bank portfolios, and banks have put on a lot of loans on their balance sheet over the last year. And so if we see a slowdown in consumer demand for loans, then I think that will be replaced by agency MBS in the bank portfolios. And there's certainly enough demand on the bank side to fill in the demand gap or shortfall that we're going to see as the Fed steps away from the market. So I think as we move into the second half of the year, the basis will stabilize going forward as investors re-engage the agency MBS market.
Thanks so much, Glenn. And we certainly touched on a lot of topics over these past 10 minutes. So just to kind of recap what we said and discussed here, it sounds like you like the high coupon, 4.5 to 5s, moderately seasoned 2018 and 2019 vintage cohorts. Mm-hmm. You think that net issuance is on track to meet our initial estimate between 6 and 800 billion. Mm-hmm. Anticipation that bank demand for agency mortgage to increase going forward due to weaker than forecasted consumer loan demand. And lastly, you think that current agency mortgage valuations represent a good entry point here for investors.
Yeah, Phil, and that sums it up nicely.
Well, thanks so much, Glenn. Always really nice to have you on the show. For anyone that has any follow-up questions, please reach out to your MUFG sales coverage to coordinate a call with Glenn. And thank you for listening to the MUFG Global Markets podcast. You could rate, review, and subscribe on Apple, Spotify, or wherever you get your podcast, and reach out to your coverage for any further information. Please check back soon for more insights from the Global Markets research team.